Worked in Tata Motors for a couple of years, then got full scholarship from US in Ohio, Cincinnati. Nutshell, I moved over there in right before the credit crisis started in 2008, early '08, and saw the entire investment banking failure and the credit crisis going on right in front when I was over there.
Yeah, I mean, so it's great. Excited to meet with someone who has been involved in the domain that I have also been involved in the past 3 4 years. Is like a veteran in that domain. So I'm like glad to
Well,
have.
not that much veteran, but yeah.
Until I went through your SSSN and all that you've done, right? So yeah, also because we are constantly learning, right? In we are in the process of right now doing that, and also so it's great to have you on our podcast series as our very first guest. You know? So
Thank
yeah.
you.
So with that said, I'll just tell you a little bit about myself. I'm a Bitspilani Alam, co-founder at CEO Finance. We are also trying to help people, retail investors, invest better through our insights-based and ChatGPT-based platform. So yeah, that's a little bit about me. Tell
Yeah,
me.
so my name is Maneesh Nath Srivastava. As you're aware, I did my undergrad from NIT Surathkal, worked
Mhm.
in Tata Motors for a couple of years, then got full scholarship from US in Ohio, Cincinnati.
Yeah.
I went over there, studied over there, then moved into finance gradually after working in industrial companies for a few years. My passion was in finance from the very beginning. I just wanted to have some engineering experience before moving into finance. And then I worked in a company called Capital One Bank over there in Richmond, Virginia, Washington, D.C., and in Boston. Then I moved into a company called Market Group, which later became IHS Market and now merged with S&P Global
Yeah.
at a value of almost $44 billion. So that's in a nutshell. I moved over there in right before the credit crisis started in 2008, early '08, and saw the entire investment banking failure and the credit crisis going on right in front when I was over there. So it was quite a learning even from that aspect. And then simultaneously, I was doing a lot of value investing work. Then early 2011, I thought that if I can do much more detailed work
Mm-hmm.
area, I can become a much more seasoned investor and do it full time as a more like a fund manager, as a full time portfolio manager. So that's why I came back to India. I started focusing on the Indian companies. Earlier, I was in the US markets. Then I fine tuned the framework for the Indian companies, then for the Indian markets, and then down the line. I met a small US hedge fund, Arkstone Capital in US.
Yeah.
I showed my work and I joined them in 2013 and started focusing on the small cap companies. Then performance was quite good over there and learned over there a lot. And eventually was able to understand that what goes in the making of good companies. So earlier it was that okay, whether it is on what are the main characteristics on which the company's future growth, like how to find good multi-baggers, like that was the like the holy grail which I was after from the
Yeah.
very beginning, and on how to spot them early on, because once they reach a certain point, then the
Yeah.
valuations also kind of catches up, and the valuation actually goes very high. Then the growth also declines after a certain stage. So that was the entire process which I have developed over the last two decades,
Yeah.
and that's in a nutshell some brief, and we will kind of go in detail uh,
Yep.
during this meeting. So.
Yeah, definitely, Manish. Yeah, so thanks a lot, for like laying down your journey till now. So it's a very interesting and fascinating one. So I went through like what you have accomplished till now. Like I have seen that you founded like Century Partners Capital like around 2010, right? So, if you can tell me about how did you do that and how did you, develop this systematic stock selection process? for
Right.
the EU and Indian markets? Like, what
Right.
exactly is your investment philosophy behind that?
Yeah.
Yeah.
So as I said, my main goal was always trying to understand the stock market, the companies, what differentiate a good company from a bad company, what makes a good investment, because sometimes a good company cannot may not be a good investment. So all these nuances. So for that, I stepped out of the market and started doing a lot of fundamental research and trying to understand from the past centuries, good fund managers, portfolio managers, value investors, and the details about good companies, what goes in making of those companies, what kind of characteristics are there, which kind of industries produces the biggest winners, and so on. And then using that framework and fine tuning it for the Indian markets. So I came back to India in 2011, and from there I started doing Indian understanding more of the Indian companies, and from there on, like the journey was quite interesting. Over here, the data is not that clean as compared to the global markets, as we know, and so it requires lot more understanding fine nuances within the company's business model, what's going on in their financials, and so on. So it's a bit intricate over here, but the rewards are also quite good because India is a 30-year bull run story from here. So
Yep.
when we will be looking back in 2050, we will look at this as a launching pad for the growth which is ahead of us for the
Mhm.
next 30 years, and a lot of wealth will be created. Now our job as a fund manager, as a value investor, is to find those wealth creators early on. So coming back to the framework, so main thing was trying to find out whether the future growth can be predicted based on the past 10 years, 5 years of financial data.
Mhm.
So I started doing a lot of analysis, lot of trial and error kind of financial modeling, and then based on that, I found out that okay, these are some of the characteristics which, from my background, I can understand that whether this will make sense. On at what confidence level we can use this framework to find the future multi-baggers. So it's always easy to look in the past and say, okay, that this company has done well, that company has done well, I could have catched that. But one thing is that you are doing it and the market is giving you the feedback, and you are doing it full time. You are using your own framework, and through which, if you are right, then you are making money. If you are wrong, then you are losing money. And that's the thing which creates a lot of learning. You use a feedback loop, that okay, if Astral is going up, one of my multi-baggers, almost 100x in the last decade.
Yeah.
Um, and then the companies which are not doing good, like companies like RS Software, where there was a client concentration risk. So trying to understand what makes Astral click and what makes companies like RS Software, or the guys kind of takes as I was saying, on how to, like, what makes the Astral clicks and those using those properties, and
Mhm.
then what was not working for RS Software or those kind of companies which were going down, and that's how you will kind of at least I kind of learned, and I created the framework and use the principles. Let's say if I'm seeing that okay, if the profit growth rate and the sales growth rate and the return on equity, return on capital employed
Yeah.
are like good, are good for a particular company for over a
Yes.
past 5 years of period,
Mhm.
and if they can maintain it for the next 5 years, then they will have the similar kind of stock price appreciation as well. So that kind of mindset, and then over a period when you do it for a long time, and when you are studying the global markets, 50,000 stocks, trying to understand what's going on in any part of the world in the stock market, and try to read as much as possible, then you come up with some solid guidelines. Okay, that this is the framework, this is how it works. It need not be in a very precise way, but it's a range where you have to kind of work in that range, and then again you will apply, and then again you will learn, because the market cycles will change.
Mhm.
Markets keep on changing. So sometimes you are in the bull market, sometimes you're in the sideways market, sometimes you are in the downtrending market. So for every cycle, the market feedback will be different for different companies, and especially in the companies where I am operating, where I'm in the micro cap, in the small cap area, they get punished very easily in the bear market or in the
Yeah,
sideways market, because the flight to safety happens and people leave to the large cap or to the developed market. So that's how
yeah,
then your framework and your conviction actually gets really tested, because staying in the market and not making any money for 1 year, 2 year, I mean, um, uh, is that's where your conviction really gets tested. It will be tested over there, and if you are good in that in your framework, and you have a good understanding, and you are a seasoned investor,
yeah,
eventually you will learn the traits, and you will be um, much comfortable in dealing in those kind of scenarios down the line.
hmm,
For initial one, it will look like that whether is it worth it, or whether you will start doing self-doubting on your capabilities, and eventually that will lead to some bad results. But if you are confident on your framework, so it's like this, that you have to be very confident when you are creating the framework, doing lot of work beforehand,
yeah,
and then you see the feedback, then you reframe it in your in your guidelines, and then come up with a new framework, and then you keep on fine tuning it till you are able to crack the code, or at least whatever works
yeah.
for your particular kind of background or skill set.
Hmm.
So that's in a nutshell what I.
Nice, nice. That was really descriptive. I just wanted to ask you, like you have yourself been, more than 2 3 market corrections, like 2000.com, then 2008 crisis, then 2020 COVID as well, right? So you have been through these market corrections as well. So the framework that you have deployed, and if you have still working on it, so do you like stress test that particular framework against these market corrections, as in what will be the impact of, let's say, if you're back testing it for 5 years, 10 years, that particular universe of stocks, because sometimes if a particular strategy is not stress tested against these crises, then it gets biased results, in the forward, you can say, out of sample data. So yeah, what's your take on that?
Yeah,
How do
yeah.
you do
So
that?
yeah. So to kind of begin with, I started with almost a century worth of data of
Oh,
20th century. Yeah. So I started with that, and I saw that okay, equities are like the best asset classes compared to other asset classes. Then among equities, if you can handle it, then the small cap the stocks are like the best bet. So from there, and then what worked, and then small cap became mid cap, then mid cap became large cap. So you had like plenty of data. And in the investment world, everything is almost similar, whether it was last century or even in the 21st century.
yeah.
The fundamental analysis doesn't change much. The
Mhm.
companies will change, the industries will change, but it's all about finding good companies early on, with good management, with good leadership, with good business potential over the next decade. And if you are able to do it consistently, you will make decent amount of money. And that's what investing is all about. And given the bear markets, as you kind of described, bear markets will happen from time to time.
Yeah,
It's your conviction on those during those time, those period, on how well the portfolio companies are doing at that particular time, and how much conviction you have in your portfolio at that
yeah,
time in your strategy, is what will distinguish you from the others.
yeah.
So I think the crisis will always be different,
Mhm.
but the good companies will always come out of that. They will find a way, and that is why to have a diversified portfolio of
Mhm.
almost 20 to 30 stocks is a good idea.
Yeah.
and not betting your entire savings on like one stock or like five stocks may not work out for someone who is in a beginner stage.
Yeah.
But so having a diversified portfolio will
Yeah.
save you from these kind of crisis, and the crisis will always be there. After every 3 to 4 years, you will have some new kind of issues going on in the global markets, in the local market, and some political changes will happen, and some new policies will be there. But what I have seen is that if the company has very good product and it's driven by a very good leader.
Yeah.
Uh, both the characters, both the horse and the jockey, if they are good, you are bound to make money if you are able to stick with it for a period of time, rather
Mhm.
than jump from like one stock to another stock.
Yeah.
I think you have a good framework, find good companies, create, and then just keep on adding to your winners,
Yeah.
and just don't lose your patience. I think that's what, in a nutshell, what I have learned.
Yeah. Yeah, this was extremely helpful. You talk about patience and perseverance, so that is extremely important when it comes to investing. So you also mentioned a diversification. So whenever a retail investor comes to investing or is like start investing, there is always these two terms he or she comes across with, that is returns and risk, right? And some say that diversification helps in mitigating risk. So can you like drill down on how exactly you manage your risk and how diversification has been helping you?
Yeah. As many people have said, risk comes from not knowing what you are doing. And if you are confident on your strategies, in your abilities, in your ability to find good companies,
Mhm.
and you have created a solid portfolio of 15 to 25 or almost like 30 companies,
Yeah.
um, if some of them does well, let's say, yeah, out of 20 companies, if two become 100x in the next 10 years,
Yeah.
uh, your portfolio will become 10x automatically. So without even talking about what happened to the remaining 18, we are
Yeah.
not even discussing just two companies out of 20. So that's the kind of mindset I gonna go in, and risk will always be there in the portfolio. Only way you can do is that you can minimize the risk based on your past decade or past learnings. So you learn from your mistakes, learn from your winners, learn from your losers. Both are equally important. So not to repeat the same mistake over and over again. So that's one of the basic things.
Yeah.
What I have found is that companies which are leveraged with corporate governance issues, they may work for some period of time, but
Yeah.
eventually it's to come up with a consistent strategy. You have to really get into the basics of the business, of the fundamental, of the valuations,
Yeah.
and once you have done that, then you will be in a position to find some of these good multi-baggers early on. So let's say I start with a 100 crore kind of market cap
Yeah.
to 2,000 crore market cap, where there are almost like 1,500 companies in the Indian markets. And if I start screening some of the best in this, I will be left with, let's say, 150 companies, and let's say almost like the top 10%. And from there, I will go and deep dive into these companies and study their business model, their annual reports, what the management has been saying in the past 5 years,
Yeah.
and see that how they are delivering on that, and the financials, their growth rates, their consistency. Because if they are not able to come up with good results when they are at 100 crore to 500 crore, like to 2,000 crore market cap, how they will be doing business when they are with the big boys, when they will reach like almost 10,000 crore kind of
Yeah.
market cap, right? So it's like this, that at the micro cap, at the small cap level, the growth rate should be excellent. The fundamentals should be very self-evident, should be very consistent, and that's the way you will find out. And eventually, you need only a few of them in your
Yeah.
portfolio. So not to worry too much on the companies which are not performing well, because we are focusing on the companies which will perform well, which are performing well, and that's the way. If the companies are performing well, we reward them with giving them more allocation next year, and that's how you can build a position. Because if a company has to move from 300 crore to 30,000 crore in a decade, it has to go via 3,000 crore uh, point, right? So it can't just jump from 300 crore to 30,000 crore. So it's going to be a gradual progression.
Yeah,
So if we find some good companies, we can just keep on investing, keep on increasing that allocation over a decade. So if the companies are not doing good, and even a good fundamental company may not be able to do
yeah,
well in some of the markets, so give them some time. Don't worry, don't panic. And if the framework has been proven framework, and if you are confident on companies, just wait and watch. That's my philosophy.
yeah,
And risk will always be there. As I said, if we remove the leverage part,
yeah,
maximum part of the risk is gone actually. So in like this is what I've seen, like your very high debt, very high pledging,
yeah,
some corporate governance issues. So these are the three things. If you can avoid, you can mitigate a large portion of the risk.
yeah,
And some risk will always be there. Some new regulations can come in and all that. But as I said, we are focused on 20 companies, not on
yeah,
two. We are not allocating on those only on 5 companies or on 10 companies, right? So that's the diversification kind of kicks in over there, and it helps you. Yeah.
yeah, yeah. Got it, got it. That was extremely helpful to know. And also on that part only, I wanted to mention like Warren Buffett also, one of veteran value investors. So he has like 40% of Apple stock in his portfolio. And if you sum it out, he has around 40 to 50 stocks. But the majority of returns that came to his portfolio is coming from the Apple stock that he has held for more than 12 plus years. So yes, you are right about that. You just need to pick out those two, three gems, in the portfolio that will actually mitigate or hedge your other risk or losses from other stocks. So yeah, I just wanted to ask, like to decide a particular framework, or to pick a certain baskets of stock. What exactly like the strategy that you follow? Like fundamental analysis? Do you look at market trends, sentiments? Do you look at news? Like, so I wanted to uh, know about
Yeah.
that.
So I look at mainly at the financials of the past 5 to 10 years, and then use that information to find the highest growth rate
Yeah,
company with undervaluation
yeah,
in mind. Because if a company is trading at, let's say, 100 P level,
yeah,
and it can be kind of growing at a very high growth rate, uh, percentage in terms of their sales growth or in their profit growth. But
yeah,
if the valuations are not appealing to me, I will avoid them. Because it takes a lot of time to for a company to move from point A to point B.
yeah,
From 10x growth happens in a very long period of time, but it can fall for a small mistake of its own very quickly. So it's better to be with the safe companies with high growth, but at a decent valuation. So decent valuation means like at a PE level of less than 40. 40 is like my cutoff, and I will prefer it way less than 40. But I'm just saying that in case if I'm very attracted to a particular script,
yeah,
that's the max which I'm willing to pay. So then valuation wise, so once I have found the top 100, 200 companies, uh, using the principles I just said, like I remove the companies with high valuation, remove
yeah,
the companies with low growth, high debt, leverage, pledging, and you are left with, let's say, 200 companies. So over there, I will go in deep dive in those companies, look at their website, business model, their
yeah,
annual reports, and see where they are going, and see which companies fit in my circle of competence, my area of expertise, based on the past experiences I had in those industries. So, like people say that some of the companies are in pharma are doing extremely well. So, yeah, pharma has been very good for the Indian markets over the last two
true.
decades, actually, if you can see. Because India has become the pharma, like the pharmacy of the world, as they now kind of say it, right?
Yeah,
So yeah, uh, and then find the top 20 companies and just create a equally weighted portfolio, and then monitor it on a monthly basis, on a quarterly basis, yearly basis, and see what kind of growths are happening, and then use a principle where I will be adding on to the winners
Yeah,
more. And if a company is not doing well, then there is no need to panic also,
yeah,
because sometimes the companies will take some time to come up, and then it's much better to focus on what's working at that time in that particular market, and then just keep on adding to those companies as long as they are delivering. So, and eventually you will have a sound portfolio with good performance over a decade. Yeah.
yeah. Yeah, so that is a very, well thought and structured investment strategy. Like I also, do company health checkup, but I don't drill down or deep dive into, a lot of fundamentals like you just mentioned. So it was extremely helpful. I just wanted to ask, whenever it comes to trading or investing, I've seen like people don't have, patience. Like let's say if they bought something and it's giving them negative returns or loss, in the first week or in the first day, they start, buying some other stuff or just selling it and buying it again, hence accumulating losses, so do you have any sort of fixed principles or rules, when it comes to trading and investing? Let's say two trades per week or per month, or it doesn't matter if they're loss making or profit making, like something similar to that.
Yeah, so I am more into long-term investing. Everyone has their own comfort horizon, whether it's a week or a month or in a year. For me, it is at least a couple of years. And if in those 2 years, if I am holding on those stocks and they are coming up with good financial performance, even if the stock price may not be kind of catching up with their intrinsic value, it's okay, because eventually they will catch up. So if the intrinsic value is over here and the stock price is over here, in some period of time they will meet. And they can meet like the next day, or they can meet in the next couple of years. That we have to see. But as long as the company is coming up with good returns, good profit growth, good margins, and there is a well thought out plan for future product lines, and so on. The management is good. They are doing uh, decent work. The valuation of the company will keep on rising, and that's where we are focused. And in the trading world, it becomes it's a different game, and
Yeah,
it's for different kind of uh,
yeah,
mindset. Yeah, like people with a very different kind of mindset than long-term investor.
agreed.
So it's one's choice, and everyone has to have their own risk management in place, whether it's in trading, whether it's in long-term investing. So in long-term investing, my mantra is that don't invest in the companies which are not performing in terms of stock price, in terms of their valuation. If they are going down, it's okay.
Yeah,
No need to kind of panic and sell it,
yeah,
because they can actually kind of come up. But right now, I will be focusing on the past year, like the top 60% performers, and
yeah,
then use that as a metric to add on to those, and then find some new ideas over a year. It's if you can find a few winners
yeah,
in a year, and you are working in the micro cap, in the 300 crore uh, market cap range, you have a long way to go from there if you are able to catch some of them.
yeah,
So, I think in a country like India, where there is so much amount of growth happening in all the sectors, all the industries, I think it's a good place to start looking for good companies, good micro caps, good small caps, and yeah, that's my.
it's nice. So basically, look after the companies who have decent growth opportunities or decent revenue and not overvalued. Got it. Yeah. So I wanted to ask you in terms of like when it comes to investing, right? So people have a lot of doubts, as in when to invest, how much to invest, right? Where to start with, So, do you have any sort of advice or any plan that you have also followed in the past when you were also beginner for the people who are actually coming into investing but really don't have any idea where to begin with?
Yeah, once you have some basic idea of the companies or the valuation of the stock market, I think theory is okay. But after a while, investing the real money, you will make some mistakes on the way, and we all do.
Yeah,
And over a period of time, the market will give you the feedback, and that's how you will start developing your strategy, your framework and your guidelines on what to do and what not to do and in what yeah, so those are the things which one has to it's all about education. It's all about being a continuous learner
yeah,
and be very modest in your approach. Markets have their own way of working, and it's a very like IQ level is required. Very high IQ level is required, obviously.
mhm,
But more than that, the patience, the behavioral part of your psychic is also very much into play,
yeah,
because when the market is down, there is lot of uh, blood on the street, and then you are entering those markets. So it's a very different kind of contrarian approach one has to take, and it's not easy for everyone. Everyone is not kind of built for this.
yeah,
But just like I cannot give an example, when there is a fire in a building, the firefighters are the one who are going in when everyone is trying to come out of that building. So because they are well trained and they are well equipped, they have the skills, they have the tools, they have the they have the experience on how to extinguish the fire, right? So in the same way, when we find good opportunities in the market, when everyone is coming out of the market, that's where we are actually coming in, and we are trying to find good companies at a very downtrodden kind of valuation.
yeah,
So yeah, so that's comes with experience, and uh, everyone has a learning curve.
yeah,
So just keep on working, keep on learning. There are a lot of good investment website, tools, seminars.
yeah.
Very big investors in the world like Mr. Warren Buffett, Charlie Munger.
Yeah.
Just try to learn from those is enough to kind of get you started.
Got it, got it. So basically, a patience, continuous learning, and research. Three
Right.
pillars, you can say. Got it. I just wanted to ask, like a lot of retail investors who are also investing, long-term investing, they are actually sometimes doubtful about how exactly could macroeconomical factors like interest rates, right, or inflation could affect their portfolio. Like Fed has been raising interest rates, ECB has been raising interest rates. So I just wanted to know, like, how would these like inflation or interest rate would exactly affect a common person's portfolio, right?
So it does affect, because if interest rates are very high,
Mhm.
investors can go and just start parking their money in the bank with the in the bond market, and yeah, so yeah, interest rate does play a role in the short term, but eventually, if a company is doing good and they have a good offering, they are growing, and the management has the vision, um, some investors will start looking at that as well. No matter what the interest rates are, no matter what the inflation is. And if the inflation is high, then it's always good idea to be in the stock market,
Mhm.
because good companies with economic mode, they
Yeah,
have the pricing power. They can pass on their increase in cost and inflation to the consumer,
yeah,
and they can come up with good revenues in any kind of market. And yeah, so I think equities, so inflation and interest rates, they do affect, but as I said, these are like short-term kind of issues. The main thing is whether we are able to find uh, 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 good companies early on. That is in our control.
Yeah.
There are a few things which are not in our control. So
Yeah.
let's not worry about that too much.
Got it.
Investing in any kind of environment is okay, as long as you are as long as you know in which companies you are investing and for what reason, and what is your rationale, and what are you learning from those investment. And if you have that in place, I think it's okay.
Yeah. That totally makes sense, right? To me as well, because I've also been investing like for the past 8 years since the age of 16, because my dad has been an avid investor. So I have, like gone to these terminals and have seen like people sometimes freaking out, inflation is up, please sell all your portfolio, all that. So yeah, I mean, thank you for addressing that. Key, that is not the priority. The priority is actually getting in first to the stocks who have value, right? Growth value. So yeah, so thanks a lot, Manish, for joining us on our very first podcast session. So any last minute advice you want to give to our viewers or the retail investors that we have would be great. Like any last sentence or something.
Yeah, as I said, investing comes with lot of practice. Like theory is good, but start investing, whether it's a small amount, and you will learn on the way.
Yeah.
And it's an interesting journey if you enjoy the investment process. And yeah, and it's a very interesting industry to be in. You kind of you face new things on a daily basis. New companies are coming up in the stock market, new IPOs are coming, and you have lot of good things happening in the market, like in those companies, lot to learn from them. And yeah, and if we are able to find some of the multi-baggers early on, there
Yeah.
is a decent chance that we can do extremely well in our investment journey. So yeah.
Got it. Yes, thanks a lot, Manish, for joining us. Right,
Yep.
it was great to have you on a session. I personally learned a lot from this session. It was
Yep.
not.
Yep. Thanks a lot. Thanks a lot.
Yeah,
Thanks a lot.
definitely. So
Okay.
yeah, I'll just edit the script, right? Me and Himanshu, and we post it. Okay. Yeah.
Perfect.
Okay.
Okay. Thank you. Bye.
Thanks for joining.